Hello friends, today we are going to talk about why you need life insurance. So this is called a no need objection. So when somebody talks about a no need objection, I don't need life insurance, then you can actually tell a story which is basically from England, and which is an actual story which happened long time back, which actually gave the concept of insurance, which actually brought the concept of insurance. Prior to that, the insurance as a concept was not there. And how do you explain this? Why do you need life insurance is what, the whole principle of insurance is explained in this story. So this story becomes very interesting because the basic core of insurance is understood very clearly by the client, and that is what is very, very important. And therefore this particular thing, we are going to discuss that particular story. So what happened a long, hundreds and hundreds of years before, on the port of England, when it was very long back. So there used to be these merchants who would send their goods with in lot of ships across the world. And at the port, there was one small boy, I don't know his name, but he was there, and he used to actually, he was a tea boy, and he would distribute tea. His boss was there, and he would distribute tea to all the merchants, and he would also overhear what they were talking about. And therefore he used to take keen interest about about the business that they are doing and about things that were happening. And obviously he came to understand that this was a risky business, and that many times the ships would actually, because of lot of storms in the sea, many times the goods would be lost, the ship would be lost, and then there would be lot of loss that they had to incur. And he used to listen to this. It took many years for him to really understand how this whole business works. And then one day what happened was, he started thinking that all these people who are sending these goods, he started making a note of it. So he would actually ask people when they are sending the goods by the ship, he would keep a note of that, and then he would actually write against it whether the goods reached the destination in good order and condition, or if they were lost. And that is where he started making notes. And over a period of 4 to 5, 6 years, once he analyzed that data, what he realized was that 20% of the ships used to get sink. So it's like data of over 4-5 years, and obviously if you have data, it can really create some very amazing results. Now this boy, after having kept this data and understood that generally he was seeing that if 5 ships are going, there was one ship which was losing all the goods. But now the problem was that he understood that anybody could lose that. Although overall the ships, it was 20% loss, but for one individual merchant it would be 100% loss. And therefore when he analyzed this, he had a meeting after that with all the merchants, and he told all the merchants about his this analysis. And he told them that this is what I have come to the conclusion, that for over 5 years, and then if it is 5 years data, obviously nobody had collated and put it together. So if it was 5 years data, it was definitely right, almost correct. So all the merchants he called, and he told them that this is what I did, this is how I asked you, and this data I have collected, and I have found out that 20% is the loss in this particular business. So which means out of every 5 ships that sail out, 1 will be lost. Now the problem is, we don't know which ship is going to be lost, correct? And therefore the merchant individually faces this risk. The risk is between 0 and 100%. 0 means there is no risk, the goods are reaching. The second is the 100%, where all the goods are lost. And therefore if this is the risk which each merchant is carrying, but unbelievably, if it is one ship which gets sunk out of every 5 ships, so he suggested that why don't all of you make groups of 5, let's make groups of 5 and send one ship where 5 of y'all will actually distribute or divide that ship with goods, so that if one ship is lost, so instead of sending all your goods in one ship, you will send it in 5 ships. and in each ship there will be 5 merchants ka goods. Obviously what will happen if one is lost, everybody would lose only 20% of the thing. And he thought, of course, actual science had not developed by then, and therefore insurance is the principle of large numbers. It's a business of large numbers. So within 5 ships, he did not realize that time that it may not work. And what happened obviously was that the merchants were very happy. They found this as a viable solution and they thought it's a good idea. So at least we know that 20% of our risk is kind of assured. They knew that 20% would be lost. At least their 80% would get saved, and they would at least earn the money out of that. So what happened was the risk of one person was divided among 5 people. But obviously because of the law of large numbers, the next 5 years when this boy kept this record, ultimately overall again it was found that it was 20%, but many times out of the 5 ships none would sink, and many times out of the 5 ships 2 also could or would sink, and therefore again the numbers game was very different, and then he started to scratch his head. He said the original statistics remain, but yet the way he had organized to handle that original statistic was not working. And that is where he came out with a brilliant idea, and he told all the merchants, again he called a meeting, he told all the merchants, okay, we'll do this way now. He says, you send your goods in your own ship, send it in individual ships, but what you do, whatever goods you are sending, you pay me 20% of that money. So he made a bank account and he asked those merchants, to everybody, to put 20% of the amount, because he said that overall again 20% is the loss. So therefore people started believing him, because this is a wonderful thing. So they created a kind of account and a company, and they started depositing 20% into that. What this boy would do is, anytime there was a loss, the whole 100% of the loss was reimbursed by that account, and like approximately that whole money for the next 2-3 years was able to sustain the losses which happened. And therefore this boy now knew that he is doing all this work, and because of this work the merchants were very happy, because now they didn't face that particular 100% risk, and therefore they were very happy with him. And this boy also thought, I need to get something, and that is where he started charging them a small premium of 5%. So instead of 20%, they would pay 25%. They would be rest assured. Now, my dear friends, what does come out of this as a principle? So I talk to my clients and I tell them that what happens is, when these merchants were sending the goods in their own ships, okay, what was it? It was a loss which could be 100%. It was not a defined loss. It was a undefined loss, and it was not sure whose loss it would be. It was a contingent liability. It was an unknown contingent liability, and this contingent liability could go up to 100%. Whereas when this boy created this system where he collected this 25% money, he kept 5% for his expenses. Of course, he was doing some value addition to all the merchants. And what happened was, now the merchants definitely lost 25%. Earlier it was either they would lose or they would not lose. If they lost 100%. If they did not lose, they would lose nothing. But now what was a contingent liability now became a fixed liability, and now fixed loss for them was 25%. Now, my dear friends, do you think this makes sense? And I ask my client, Mr. Client, do you think this makes sense? And every client will say, yes, of course, it does make sense, because what we are doing is we are creating a pool of the risk. Okay, so life insurance is all about creating a pool of all the risk, so that the risk gets divided among everybody equally, and therefore the equality of the risk therefore makes it a fixed liability instead of a contingent liability. A contingent liability is a liability which may occur or may not occur. It's a loss which may occur or which may not occur. But by doing this, they made the principle of insurance. So I tell Mr. Client, the reason why I am asking you to sign this form is basically you're participating and you're pooling your risk. Everybody will not die, but the person who dies, his family will lose 100%. It's better that everybody loses 5%. In insurance hardly the cost is around 2% to 5%. So if the cost is around 2% to 5%, easily we can cover it up. And therefore, by signing this form, you are just paying a 5% of the total cost of what would happen. So in case nothing happens, it's fine, but you are going to permanently lose this 1 or 2%, and there are other people who will actually lose their family member or earning member, and they will get compensated, and therefore everybody's loss is restricted to 2% or 5%, and everybody becomes happy. So the no need of life insurance is basically that this principle of pooling the risk, of making a contingent liability into a fixed liability, is a very scientific proposition. It's basically an economic principle, and therefore it is something that will appeal. And therefore, my dear friends, I would like you to look at this video again and again and really understand this, because you may not understand it, how to pitch it immediately. So please look at this, view this video, watch this video continuously 4, 5, 7, 8 times, so that you can get the gist of what you are saying, and then try to practice this, and again you can see. Also, don't forget to put your comments in the comment box. If you get a business out of doing this, or using one of these no objection ideas, then please put in the comment box so that we can we will get motivated. Also, don't forget to put your objections that you want us to be handled in the comments. Thank you.